Collin, we're at the start of the fourth quarter. What's your Fed outlook, and how has it changed since the start of the year?
It hasn't changed too much. We assumed the Fed would gradually cut rates as the year goes on. We finally got a rate cut in September. Our outlook, though, is for less easing than what the projections suggest and what most market participants suggest, mainly because of sticky inflation. So we're seeing a softening of the labor market, but it doesn't look like it's falling off the cliff just yet. The economy has been resilient, the consumer is resilient, and inflation is kind of stuck at 3%-ish, 3% area. So given that, I think there's going to be a handful of officials who are a little bit hesitant to really commit to an aggressive pace of rate cuts from here. So we're really pricing in 1 with the potential for 2 by the end of the year if we see a sharp deterioration in the labor market.
Can you discuss a little bit more about the impact of those Fed cuts? Because for a while, at the last Fed rate cut, you saw the 10-year just kind of move up a little bit in terms of yield.
Yeah, we're not sure it's going to move up like it did last time, but we think it might kind of hold steady for a little while. We think the yield curve will continue to steepen. We'll see short-term rates fall as the Fed cuts rates. But we think there's really 3 things that can keep the 10-year Treasury kind of range-bound for now. Sticky inflation that I just mentioned, inflation near 3%. I think investors might demand a higher premium, given that we're in this, high inflationary environment to kind of compensate for that. Fiscal concerns, knowing that budget deficits aren't going anywhere. And also we're seeing some global issues where global bond yields have risen. That might put kind of a floor on how low 10-year Treasury yields can fall.
Well, we'll talk about foreign bonds in a second. But when it comes to sticky inflation, should advisors and investors turn to tips if they are worried about inflation, because the Fed just can't get down to their 2% level?
I think so. I think tips are pretty attractive right now. I can talk for a long time about tips. I'll keep it brief. There's 2 things that I think make them attractive. First are the positive real yields they offer. We're off the highs we saw over the past few years, but you can get real yields in the, say, 1.25% to 1.75% if you're looking at 5 to 10-year tips. So we think that's a nice way to sort of lock in a positive real yield regardless of what inflation does over the next handful of years. But also break-even rates. That's that hurdle rate of what inflation would need to average over the life of the tips for it to make sense. They're still in that 2.3, 2.4, 2.5% area, but inflation's closer to 3%. So break-evens, I think, look pretty attractive, and the idea that I think tips can outperform, the bar is pretty low right now.
All right, now let's talk about foreign or global bonds. Should I be chasing yield across oceans?
I don't know if you need to chase yield. When we talk to a lot of investors domestically, there hasn't been too much interest in foreign bonds over the past 10 to 15 years. But I think it's an area now that maybe investors might want to consider introducing to their portfolio. For a while, we were in this, very low or even negative interest rate environment. When you look overseas, that's not the case anymore. We can see yields that are still relatively high compared to where we were over the past 15 years. And if we look at the direction of the dollar, we don't think it's going to plunge from here, but we think it can fall. And when you look at what drives global bond performance, especially if you're looking at local currency bonds, it's usually the direction of the dollar and those local currencies. So with the idea that the dollar can fall, maybe you can strengthen those local currencies. So I think we're not diving in head first. We think for anyone who's underallocated, it's a nice time to introduce that asset to your portfolio.
So finally, if you're not that worried about a further dollar collapse, what are you worried about? What are the red flags in the market that you're worried about, that you're looking for? Is it a bad treasury auction? What is it?
It's more about tight valuations. It's not necessarily a bad treasury auction. I'm glad you asked that, because there's this whole idea that who's going to buy U.S. treasuries? Are people concerned about holding the dollar? We haven't really seen that idea come to fruition. Yeah, we saw some weak treasury auctions and maybe some foreign investors pull back in April when the tariffs were first announced. That hasn't been the case over the past few months. So we're not too worried about that. When we look at the bond market and what the red flags are, the risks, it's just tight valuations in the riskier parts of the market, whether it's high yield bonds, bank loans. You're not getting compensated too well to take those risks. So we'd rather wait for those relative valuations to improve a little bit before we suggest investors really consider taking more risk for their portfolios.
All right, well, thanks for coming on and talking about it.
Thanks for having me.